All right, welcome back for another deep dive.
Mm,
And this time,
yeah.
we're tackling a true classic,
Okay.
The Intelligent Investor by Benjamin Graham.
Oh, yeah. Love that book.
It's almost like a roadmap,
Uh-huh.
so you don't get fooled by the market's twists and turns.
It's true. It really is.
Like, think about it.
Yeah.
It was first published all the way back in 1949.
I know. Isn't that amazing?
Yeah, but even today,
Mm-hmm.
it's still considered one of the most important books
Totally.
ever written about investing.
For sure.
And it's all about,
Yeah.
building that real wealth
Right.
by focusing on the emotional discipline
Uh-huh.
and that analytical, rigor,
Yeah, that's a good way to put it.
so you can really succeed in the market.
Exactly.
So let's break this down a little bit.
Okay.
What exactly is an intelligent investor?
That's the big question.
Yeah, is it just having a super high IQ?
That's what most people think, but
No.
not according to Graham.
What does he say?
He actually says an intelligent investor
Oh.
is someone with the right temperament.
Okay, so
Yeah.
not necessarily the smartest person in the room.
No, not necessarily.
Somewhere emotionally
Right, exactly.
stable, disciplined.
Yeah, someone who can stay disciplined,
Right.
not get rattled by the ups and downs,
Right.
because we all know those are going to happen,
Totally.
and make those clear-headed decisions even when everyone else is panicking.
Okay, so that's really key.
Yes, absolutely.
Avoiding those emotional traps.
Yep.
But how do you actually do that?
Well,
Is it really as simple as just knowing the difference between
yeah.
investing versus speculating?
that's definitely a good starting point.
Okay.
I mean, Graham really drills down on that distinction.
Okay.
He defines investment as an operation based on
Yeah.
thorough analysis.
Mm-hmm.
You really got to do your homework
Okay.
and focus on protecting your initial investment
Mm-hmm.
and getting a good return. So speculation, on the other hand, is more like gambling.
Oh, okay.
It relies on trying to time the market,
Okay.
hoping to make quick profits from short-term swings.
So it's more about being like a detective
Yes,
than like a gambler.
you got it.
Oh, okay.
That's why Graham's not a big fan of speculation.
Gotcha.
He has this really famous quote.
Okay.
It says, "People who invest
Yeah.
make money for themselves.
Uh-huh.
People who speculate make money for their brokers."
Ooh, burn.
Yeah, right.
That's a good one.
Basically, speculation is a zero-sum game.
Oh, okay.
For every winner, there's a loser.
Right.
And unfortunately, a lot of times, the individual investor
Yeah.
is the one getting burned.
That makes me think of
What?
the dot-com bubble.
Oh, yeah.
Back in the late 90s.
Of course.
Everyone was pouring their money into anything
I know.
with .com at the end,
It's crazy.
just hoping to get rich quick.
Totally.
And then boom, the bubble burst.
Yeah.
And so many people lost everything. Oof.
That's exactly what Graham was warning against.
Oh, wow.
And it's a lesson that's still relevant today.
Right.
I mean, think about all the meme stocks
Yeah, yeah.
or all the crazy stuff happening with crypto.
Oh, yeah, totally.
Yeah.
Okay, so if speculation is out,
Yeah.
what's an intelligent investor supposed to do?
Well,
Yeah.
Graham has two main approaches.
Okay.
It really depends on your temperament
Okay.
and how much time you're willing to put in
Gotcha.
for the more passive investor.
Yeah.
He recommends what he calls a defensive approach.
Oh, okay.
Yeah.
Tell me more about that.
So the basic idea is to create a portfolio
Okay.
split between high-grade bonds
Okay.
and a diversified selection of leading common stocks.
Hold on. Bonds.
Yeah.
I always thought those were for
Okay.
super conservative investors.
Yeah.
How do they fit into a growth strategy?
Bonds play a crucial role,
Okay.
especially for the defensive investor.
Okay.
They provide stability. They provide income,
Right.
and they're really a cushion
Yeah.
against those market fluctuations.
Okay.
Think of them as
Yeah.
that steady bedrock of your portfolio,
Gotcha.
so you can sleep at night
Okay.
when things get volatile.
That's good.
And you might be surprised to know
Okay.
that back in 1972,
Yeah.
in his book, he actually recommended
Hmm.
keeping a portion in tax-free bonds.
Oh, tax-free bonds. That's
I
smart.
know, right?
Especially these days.
Totally.
Everyone wants to minimize that tax bill.
Exactly. Graham understood that
Right.
taxes can really eat into your returns.
Oh, yeah.
So that minimizing that tax burden
Uh-huh.
is a vital part of intelligent investing.
That's a great point.
Yeah.
So we've got our bonds for stability and
Right.
the tax advantage.
Yep.
But what about the stock portion?
Good question.
Yeah.
For that, Graham recommends investing in a diversified selection
Yeah.
of blue chip stocks.
Oh, okay.
You know, those large, well-established companies. Mm-hmm.
With a long history of profitability
Right.
and paying dividends.
So no gambling on the next hot startup.
Nope. Not for the defensive investor.
We're chasing meme stocks?
No.
No.
No,
Yeah.
this is about sticking to those tried and true companies.
Yeah.
It's not about trying to beat the market.
Okay.
It's about participating in the market's long-term growth.
Oh, that's interesting.
I know. And remember,
Yeah.
he wrote this over 70 years ago.
Yeah. Wow.
And those principles still hold up
I do.
remarkably well.
That's,
Yeah.
it's almost too simple.
I know, right?
Can it really work?
That's the thing. It's not about complexity.
Okay.
It's about consistency.
Mm-hmm.
The key to success is sticking with this approach
Okay.
over time, ignoring all that noise
Right.
and that temptation to chase those quick profits.
Oh, yeah.
You know, remember, he was writing this
Mm-hmm.
when the market had experienced a big decline.
Oh, wow.
So he was emphasizing that.
Even amidst all that uncertainty, the volatility,
Right.
solid investment principles can still work
Yeah.
and produce great results.
That's reassuring.
Yeah.
Okay, but what about
Yeah.
those of us who are like, you know,
What?
maybe a little more adventurous, a little bit more hands-on with our investments?
All right. The enterprising investor.
Yeah, exactly.
Yeah, he definitely has advice for them.
Okay, tell me more about that.
So for the enterprising investor,
Okay.
Graham recommends taking a more active role
Okay.
in researching
Mhm.
and selecting individual stocks.
Okay.
He talks about looking for undervalued companies,
Right.
special situations,
Wow.
bargain issues.
That sounds like detective work.
It is.
Which takes me back to what you mentioned earlier
Oh, yeah.
about Graham's investment
Okay.
in Savoll Tire.
Uh-huh.
So did he develop this approach to finding those opportunities
Absolutely.
after that whole experience?
That was a turning point for him. He learned you can't just rely on hype
Oh, yeah.
or good news. You got to dig deeper.
Go.
One fascinating case that illustrates this
Okay.
is Northern Pipeline Co.
Oh, okay.
This was back in 1925.
Wow. Okay.
Graham was poring over these obscure reports
Okay.
filed by oil pipelines
All right.
with the U.S. Interstate Commerce Commission,
Oh, wow.
and he discovered that Northern Pipeline was trading at $65 a share,
Okay.
but it actually held at least $80 per share.
Wait, what?
Yeah,
So the company was literally worth more than its stock price.
Exactly. And Graham saw an opportunity.
Okay.
He bought the stock,
Uh-huh.
and then he started pushing management
Okay.
to raise the dividend,
Oh,
which they eventually did.
nice.
3 years later,
Yeah.
he sold his shares for $110 each.
Wow. So he made a good profit.
He did.
I'm starting to see why he's considered a legend.
I know, right?
He was like a financial Sherlock Holmes.
So-
just like uncovering hidden value
Yeah,
where others just saw like numbers on a page.
exactly.
But how can a modern investor
Okay,
apply those same principles today?
that's a great question.
Like, I don't have the patience to sift through dusty reports.
No, I hear you. Things have changed a lot.
Right.
But the good news is,
Okay.
it's probably easier than ever
Really?
to apply his principles.
So.
Today, instead of those dusty reports,
Yeah.
you can access all this information online.
Oh, okay.
Financial statements, company filings,
Right.
industry reports. The
Right.
key is developing that ability to read between the lines
Okay.
and to understand a company's true worth
Yeah.
beyond the hype and all that noise.
So it's about being
Yeah.
a bit of a detective,
Yes.
a bit of a skeptic,
Mhm.
a bit of a contrarian.
Yeah, you got it.
Not just following the crowd,
No.
but doing your own research.
Yes.
Thinking for yourself.
Exactly.
This is all like super insightful.
Good.
But I got to be honest,
Yeah.
the stock market still feels like a roller coaster to me.
I understand that.
Just those ups and downs
Yeah.
can be pretty unnerving.
Right.
So how does Graham suggest we deal with that?
That's a great question.
Yeah.
He has a brilliant way of explaining it.
Okay.
He uses this analogy of Mr. Market,
Okay.
this manic, depressive character
Okay.
that shows up at your door every day,
Yeah, right.
offering to buy or sell your stocks
Okay.
at wildly fluctuating prices.
Oh, okay.
Yeah.
So it's like
Yeah.
a pushy salesperson. I
Exactly.
don't know.
Mr. Market is driven by emotions,
Oh, okay.
fear and greed,
Right.
and his prices often reflect his mood swings
Okay.
rather than the true value of the underlying businesses.
Interesting.
Yeah.
So how do you deal with this guy?
You have to understand that the intelligent investor understands that Mr. Market's mood swings are actually an opportunity,
Oh, really?
not a threat.
Oh, okay.
So they wait for him to be in a truly pessimistic mood when he's offering bargains that can be exploited. And when he's overly enthusiastic, bidding prices up to like ridiculous levels, they're happy to sell to him.
Oh, that's smart.
Yeah.
It sounds great in theory, but it's hard to stay like emotionally detached when your portfolio is plummeting.
Right, it is.
Any like practical tips to deal with those moments of panic?
Yeah, there are a few techniques.
Okay.
One is dollar cost averaging, where you invest a fixed amount at regular intervals, no matter what the market is doing.
Oh, okay.
This helps you buy more shares when prices are low, and fewer shares when prices are high.
Oh, that makes sense.
Smoothing it out over time.
Yeah, like taking the emotion out of it.
Exactly. Just stay focused on the long game.
Okay.
Another strategy.
Okay.
Develop a long-term investment plan.
All right, so.
Know your goals, risk tolerance, time horizon.
Okay.
All of that will help you ride out those inevitable market storms without making rash decisions.
So have a plan, stick to it.
Exactly.
Don't let Mr. Market's mood swings dictate your actions.
Yes.
But let's be honest.
Okay.
Sometimes those mood swings can be extreme.
They can.
Are there like any historical examples?
Oh, yeah.
Where Graham's principles were put to the test?
Absolutely.
Okay.
Graham was writing from experience.
Okay.
He lived through some of the most tumultuous periods in financial history.
Okay.
The Great Depression.
Wow.
World War II.
Right.
The post-war boom and bust cycles.
Yeah.
And he uses those to illustrate the pitfalls of speculation and the dangers of getting caught up in all that hype. He provides some really compelling case studies.
Oh, like what?
Like the dot-com bubble.
Okay.
The merger of AOL and Time Warner.
Oh, yeah, I remember those.
Yeah.
That was a wild ride.
It was.
And like that AOL Time Warner merger, that was supposed to be like a game changer.
It was.
But it totally imploded.
It did.
Looking back, was it obvious it was a bad deal?
You know, that's the thing. Graham's analysis of those events shows how even the most sophisticated investors can fall prey to like irrational exuberance and make bad decisions.
Wow. So you're saying even the pros mess up sometimes?
Oh, yeah. Definitely.
Yeah.
One particularly striking example is the 3Com situation.
Oh, yeah. Remind me about that.
Okay, so back in 2000, 3Com, they were a networking company, decided to spin off their Palm division, which made those like popular handheld devices.
Right.
They did an IPO of Palm, and the stock went through the roof.
Oh, wow.
But here's where it gets crazy. After the spinoff, the market valued 3Com's other businesses at negative $22 billion.
Negative $22 billion?
Yeah.
How is that even possible?
It's a testament to how irrational investor behavior can get.
Wow.
The market was so fixated on that hot Palm stock that they completely ignored the value of 3Com's core business.
It's a perfect illustration of Graham's point. When speculation takes over, logic goes out the window.
Exactly.
But this raises an important question. How do you stay grounded? Like, how do you avoid getting caught up in those frenzies?
Well, one of Graham's key principles is the importance of shareholder activism. He believed investors should hold management accountable, demand efficient operations, actively engage in corporate governance.
So it's not just about picking the right stocks.
Exactly.
It's about being an engaged owner.
You got it.
Gotcha.
He was particularly critical of passive investors who just buy and hold without paying attention to how companies are run. He believed investors have a responsibility to hold management's feet to the fire and demand they act in the best interests of the shareholders. He even said the rank and file of stockholders should be open-minded enough to read the proxy material and weigh the arguments on both sides.
Wow, that's pretty bold.
It is.
Especially today.
Yeah.
When passive investing is so popular.
It's even more crucial today.
Really?
Yeah. With so much money flowing into index funds and ETFs,
right.
There's less incentive for those active investors to scrutinize individual companies.
Makes sense.
Yeah.
If everyone's just riding the wave, who's going to hold those CEOs accountable?
Exactly. And that's why his emphasis on shareholder activism is so relevant.
Okay.
It's a reminder that investing isn't just about making money. It's about being a responsible owner, demanding that companies operate with integrity and transparency.
That's a good point.
Yeah, it's about recognizing you have a voice.
Yeah.
And you can use it to influence how companies are run.
Gotcha.
Yeah.
That makes sense. You can't really hold management accountable if you don't understand the scorecard. But financial statements can be pretty daunting. Where do you even start?
Yeah, I hear you. Graham dedicates a lot of the book that he emphasizes that you don't need to be an accounting whiz. It's more about understanding the key metrics and recognizing the ways companies try to make their numbers look better than they really are. A great example is earnings per share, or EPS.
Ah, yes, the elusive EPS. It feels like it's mentioned in every financial news story, but I'm never quite sure what it really tells you.
Right. It can be a valuable metric, but Graham urges caution when looking at EPS at face value. He points out that accounting practices can sometimes obscure a company's true earning power.
So it's not as simple as just looking at the EPS and assuming that higher is always better.
Not necessarily. Graham warns about things like special charges, which are essentially one-time expenses that companies can use to manipulate their earnings. They might try to write off a lot of expenses in one year to make their future earnings look better.
So it's like they're trying to make themselves look thinner by wearing a slimming outfit, but the underlying reality might not be so flattering.
That's a good analogy. Another thing to watch out for is how companies handle depreciation. There are different methods, and the choice can impact reported earnings.
Depreciation, okay, that's one of those accounting terms that always makes my eyes glaze over.
I get it, but it's important to understand that depreciation reflects the decline in value of a company's assets over time. Think about it like buying a new car. As soon as you drive it off the lot, it starts losing value. Companies have to account for that decline on their books, and how they do it can affect their reported earnings. For example, some companies use accelerated depreciation, which means they take a bigger earnings hit in the early years, but then their earnings might look better later on.
So it's just another way companies can play around with those numbers. Anything else we should watch out for?
Well, Graham also talks about the dilution factor. This comes into play when companies issue things like convertible securities or warrants.
Convertible securities. Warrants. Okay, now I'm officially lost.
No worries. It's not as complicated as it sounds. Convertible securities are basically bonds or preferred stock that can be converted into common stock, and warrants give the holder the right to buy shares of stock at a certain price in the future. The key takeaway here is that if these securities are converted or exercised, it increases the number of shares outstanding, which can then dilute the earnings per share.
So it's like the company is issuing more stock without actually creating more value. It's like a shell game with the ownership structure.
That's a great way to put it. The intelligent investor needs to be aware of these potential dilutive effects when they're evaluating a company's earnings.
This is all really eye-opening. It makes you realize how much work goes into truly understanding a company's financials.
That's exactly perfectly. Graham's point, intelligent investing requires careful analysis, critical thinking, and a healthy dose of skepticism. Speaking of skepticism, let's talk about a topic that Graham had strong opinions on: conglomerates.
Conglomerates, those sprawling corporate empires that seemed to be all the rage a few decades ago, are they still a thing?
Not as common as they were back in Graham's day, but the lessons he drew from observing them are still very relevant today. Graham was cautious about conglomerates, companies that operate across a bunch of different unrelated businesses. He felt that this lack of focus could lead to inefficiency and poor capital allocation.
So it's hard to be a jack of all trades and a master of any.
Exactly. Graham believed that companies should focus on their core strengths and avoid venturing into areas where they don't have expertise. He observed that conglomerates often become what he called OPM addicts, relying on other people's money to fuel their growth through acquisitions.
OPM addicts. That sounds a little dangerous.
It can be. Graham saw that when companies get hooked on using debt or issuing stock to acquire other businesses, it can create a false sense of growth. The underlying businesses might not actually be generating enough cash flow, but the acquisitions mask that problem, at least for a little while.
So it's like they're trying to cover up the cracks in their foundation by building a bigger house, but eventually the whole thing can come crashing down.
Precisely. Eventually, reality catches up. The intelligent investor needs to be able to see through those accounting tricks and evaluate a company's true earning power.
Okay, so we've talked about how to analyze individual companies, but Graham also stresses the importance of taking in the bigger picture, right?
Absolutely. He was a firm believer that investors should have a solid understanding of market history and the long-term trends that drive stock prices. Remember that famous chart he included in his book, the one showing the long-term performance of the Dow Jones Industrial Average?
Oh, yeah, the one that shows how the market tends to go up over time, even with those inevitable dips and crashes.
That's the one. Graham used it to illustrate a key principle. In the long run, stock prices are driven by corporate earnings.
So it's all about those profits, those bottom line numbers.
Exactly. Over time, the market tends to reflect the true value of the businesses it represents. That's why Graham emphasized finding those undervalued companies, the ones whose stock price doesn't reflect their true earning power.
That sounds simple enough, but I imagine it's harder to put into practice. How do you actually go about finding those hidden gems, those undervalued companies?
Graham laid out some specific criteria for picking stocks. He looked for companies with solid financials, consistent earnings, and a history of paying dividends. He also stressed buying stocks with a margin of safety.
Margin of safety, that sounds like an important concept. Can you explain what that means?
It's basically the difference between the price you pay for a stock and what you believe its intrinsic value truly is. In other words, it's a buffer against potential losses. Graham believed that the wider the margin of safety, the lower the risk of losing money.
So it's like having a buffer zone, a layer of protection, just in case things don't go as planned.
Exactly. And in the world of investing, that margin of safety is really important, especially for the defensive investor.
How do you actually calculate that margin of safety? Is there some kind of magic formula?
There's no one-size-fits-all formula, but Graham offers some guidelines, he suggests, looking at things like a company's historical earnings, its assets, and its dividend record to get a sense of its intrinsic value. Then you compare that value to the current stock price.
So it's a bit of an art and a science.
Precisely. It takes careful analysis, good judgment, and a willingness to be patient and wait for the right opportunities. This reminds me, all this talk about valuation makes me think about another topic that's always in the news: growth stocks.
Growth stocks. Those are the darlings of the market, promising explosive growth and huge returns. I'm sure Graham had some thoughts about those.
He did. He wasn't completely opposed to investing in growth companies, but he did warn against overpaying for them. Remember his emphasis on a margin of safety. Well, with growth stocks, that margin can be tougher to find.
Because their prices are often inflated based on expectations of future growth, which doesn't always happen.
Exactly. And those expectations don't always pan out. Graham pointed out that even the most promising companies can stumble, and when they do, their stock prices can take a nosedive.
It's a good reminder that even successful companies face challenges, and past performance is no guarantee of what will happen in the future.
That's a great point. The intelligent investor needs to be able to distinguish between real growth and hype, between companies that are genuinely creating value and those that are just riding a wave of enthusiasm.
How do you tell the difference? How do you separate the wheat from the chaff when it comes to growth stocks?
Graham suggested looking beyond the headlines and really digging into the company's fundamentals, things like their competitive position, their management team, and their overall financial health. He was also wary of getting swept up in market fads and chasing the hottest new sector.
So you've got to be a bit of a contrarian, not blindly following the crowd, but really thinking for yourself and doing your own research.
Exactly. And that independent thinking is a hallmark of the intelligent investor.
This has been incredibly insightful. It really makes you rethink your approach to investing. But I have to admit, I'm still a little intimidated by the idea of picking my own stocks. Is there an alternative for someone who doesn't have the time or expertise to do that level of analysis?
That's a great question, and Graham does offer an alternative. Investment funds, he has a whole chapter in the book about the pros and cons of investing in mutual funds, which were a relatively new concept back in his day.
Mutual funds, those baskets of stocks managed by professionals.
Exactly. Graham recognized that mutual funds could be a good option for investors who are too busy or just not comfortable managing their own portfolio. But he also had some strong opinions about choosing the right funds.
I bet he did. What kind of advice did he give on that?
Well, first and foremost, he stressed keeping costs low. He pointed out that high fees will eat into your returns, so choosing funds with low expense ratios is crucial.
Right. Those expense ratios, those sneaky little fees that mutual funds charge to manage your money, they can really add up.
Absolutely. And they vary quite a bit. Some funds charge 2% or more annually, while others are under 0.5%. Over time, those differences can cost you a lot of money.
So low costs are key. What other advice did Graham have for choosing a mutual fund?
He was wary of funds that were constantly chasing performance, jumping from one hot sector to the next, always trying to beat the market. He thought this kind of short-term focus could lead to higher risk and ultimately lower returns over the long haul.
So the key is finding those funds that are in it for the long game, those focused on steady, consistent returns.
Exactly. Graham preferred funds with a more conservative approach, one that emphasized diversification and value investing. He was also cautious about those funds that were very small or brand new, as those can be riskier and less stable.
So it comes down to finding a fund that aligns with your own investment philosophy, your risk tolerance, and your time horizon.
That's right. And doing your research to understand the fund's investment strategy, their track record, and of course those fees before you invest.
This is all incredibly helpful.
Yeah.
It really highlights that investing doesn't have to be this scary, complicated thing with the right knowledge and approach. Anyone can become an intelligent investor.
And that's precisely what Graham set out to prove. He believed that investing is a skill that anyone can learn and master regardless of their background, and that anyone can achieve financial success.
Yeah, this deep dive has been, truly enlightening.
Good, I'm glad.
It's given me a whole new perspective, honestly, on how to, approach the market and build wealth over the long term.
That's great.
But there's so much information out there.
Yeah, that's true.
So much conflicting advice and noise.
Yeah.
How do you even filter it all out?
Well, that's where Graham's focus on independent thinking is so important.
Right.
He really urged investors to be skeptical of all that Wall Street hype.
Oh, yeah.
To question assumptions, do your own research.
Okay.
He even cautioned against
what?
Relying too heavily on financial advisors.
Oh, interesting.
Reminding us that we're ultimately responsible for our own decisions.
Right. So it's about taking ownership.
Yes.
Not blindly following everyone else.
No, you have to think for yourself.
Or trusting someone else.
Right.
To make those big decisions for you.
Exactly.
So it's developing that critical mindset.
Yeah.
And figuring out how to separate fact from fiction.
Exactly.
It's like being your own financial detective.
Exactly.
Yeah, I love that too.
That's what the book is all about.
Okay. Equipping you with those tools
so
you can become an intelligent investor.
This has been an incredible deep dive.
Thank you.
We've covered so much.
We have.
From the psychology of investing to analyzing those financial statements, from the importance of diversification to the dangers of speculation.
It's a lot.
It's clear that The Intelligent Investor, it's a timeless classic.
It really is.
For a reason.
Absolutely.
So let's recap some of the key takeaways for our listener.
All right.
First and foremost, Graham emphasizes temperament over intellect.
It's not about being the smartest person.
Right.
It's about being patient, disciplined, emotionally in control.
Right. And understanding that the market is driven by emotions.
Absolutely.
So the intelligent investor needs to rise above that.
Yes.
To make those rational decisions.
Very good.
Another key point is
the difference between investing and speculating.
Yes, that's a big one.
Investing is about analysis, protecting your investment, and earning a good return.
Solid return.
Speculation is about timing the market.
Yeah, trying to.
And hoping for those quick profits.
Right.
Which usually just end up benefiting your broker.
More than you.
Yeah.
Exactly.
And Graham gives us a framework.
He does.
For making those decisions.
Yeah.
Whether you're a more passive investor, looking for that defensive approach, or you're more hands-on, like the enterprising investor, who's ready to dig in and do the research.
That's right.
We also talked about understanding those financial statements, watching out for those accounting gimmicks.
Oh, yeah, I gotta be careful.
And recognizing those potential pitfalls.
Right.
Like conglomerates or chasing those growth stocks.
It's easy to get caught up in that.
It is.
Yeah.
It is.
Yeah.
So it's about being a critical thinker.
Yes.
A skeptic. Making those independent decisions.
Right.
Not following the crowd.
No. Do your own homework.
But doing your own research.
Yes.
And developing your own philosophy.
I like that.
Yeah. Your own approach.
And for anyone who prefers that hands-off approach, Graham gives advice on choosing those investment funds.
He does.
Emphasizing low costs.
Yes.
A long-term focus. And a consistent strategy.
Right.
So find a fund that aligns with your goals.
Exactly.
Your risk tolerance. And your time horizon.
That's right.
And remember,
yeah.
even if you're delegating,
okay,
you're still responsible for your success.
You are.
This has been like a masterclass.
Oh, wow.
In intelligent investing.
I'm glad you think so.
But it's just the beginning.
It is. There's so much more.
Graham's book is full of insights and wisdom.
It really is a great book.
That can guide you throughout your journey as an investor. And one final thought.
Okay.
Graham believed that the intelligent investor is a perpetual student.
Oh, that's interesting.
Someone who's always learning.
Right.
Adapting, seeking to improve their understanding of the market.
So keep exploring.
Yes.
Keep questioning.
Keep learning.
And never stop learning.
That's right.
That's the real key to success.
Exactly.
Awesome. Well, thanks for joining me on this deep dive.
It's my pleasure.
Into the intelligent investor.
Anytime.
We'll see you next time.
Sounds good.